Hello, very good morning to all and welcome to a brand new trading week. I'm Kelvin here. Very good morning. Welcome to a brand new trading week. Today will be Monday, the 21st of July 2025, and I hope that you all have a great and restful weekend. So before we kickstart the gist of our daily dose for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, before we jump straight into the short-term intraday technical outlook on the four major US dollar pair, the six major stock indices, and as well as the two commodities asset class, which is gold XAU/USD and West Texas crude oil. Let's have a quick recap what has taken shape in terms of the intraday performance on these broad-based cross asset classes from Friday and as well as in today's early Asia session, taking into account of their respective relevant economic data release and as well as events news flow that had occurred from Friday and over the weekend, and as well as in today's early Asia session before the start of our daily dose at 11 a.m. Singapore time. So let's have a look at on Friday US session, what are the key data that has kind of impacted the major US stock indices movement. So let me quickly switch over to my screen over here. All right, so on last Friday, we have a tier 1 US economic data release, which is the University of Michigan consumer sentiment data, and this is the flash data, a kind of a preview for the month of July. So why consumer sentiment is considered tier 1 data in the US? Because we know that 3/4 of US GDP growth is driven by the retail services industry or the sector, and what drives retail services is retail spending or consumer spending. And in order to gauge the health of consumer spending, consumer sentiment will tend to be a leading gauge on whether consumers are willing to spend more or spend less. And this soft data is being compiled by University of Michigan based on the survey-based format. They actually put a list of participants, asking them several questions, and from there they're able to actually get a aggregated score. So this time around, the consumer sentiment, later I'll share with the chart, but let me touch on the headline figure first. So this time around, they actually show a slight improvement from 60.7, pardon me, 60.7 that was printed in the previous month of June, inch up slightly higher to 61.8, and also going slightly above consensus at 61.5. So if you look at the trend, okay, let me go back over here. Okay, so this latest flash figure for the month of July of 61.8 is the highest in 5 months. All right, so what you can see over here is that previously it was declining pretty much drastically since December last year. All right, it hit a rather low of 52.2 in May, and from there onwards there seems to be a slight uptick to going above the 55 level mark over here. So but however, you look at the bigger picture trend of a 10-year trend over here, it still continues to print a series of lower low and lower high so far. So what we could see over here is that yes, we may see a slight uptick in the month of July for the University of Michigan consumer sentiment that hit a 5-month high, but overall the longer term major trend seems to us that it's still sloping downwards, right? There's no clear change of a trend yet. So something to actually bear in mind for over here is that consumer sentiment may starts to turn weaker again if trade tariffs fear starts to actually resurface in the global markets after 1st of August, which is the extended deadline by the current US White House administration dictate that after 1st of August, if countries can't actually come to terms with the ongoing negotiation that US has with the various trading partners, the higher reciprocal tariffs will start to take into effect. All right, something to look out for going forward. And also, very interestingly, the this University of Michigan consumer sentiment, it has various subcomponents, and one of the subcomponent, it actually asks the survey participants what's their view like will be in the view of US inflationary trend 5 years from now, which is the date of the survey that's been conducted, and 1 year from the date the date of the survey that's been conducted. So taking away that it's kind of a forward-looking inflation expectation from the targeted survey participants as done by the University of Michigan. So for the 5-year inflation expectation, that's the long term, it's still rather high, despite that it dipped down slightly to 3.6% from the previous month of June, which is 4%, and still way above the Federal Reserve preferred long-term inflation target of 2%. And the 1 year forward-looking one, the small shorter term, so this Michigan inflation expectation, this is the 1 year. For the month of July, it also went down slightly from 5% in June. Then for the flash July figure, it printed 4.4%, but still rather high above that 2% long-term Federal Reserve target. So overall, what we could see over here is that yes, inflation trend expectation 5 year from the date of the survey and 1 year from the date of the survey inched down slightly lower than the previous month of June, but they are still remains in a very high elevated level away from the Fed desired long-term target of 2%. So inflation risk picking up is still pretty much prevalent as what being transpired in this latest University of Michigan survey consumer sentiment report that was released on last Friday. All right, so with this I would say that it's a bit not so really that bad because consumer sentiment pick up, but inflation still remains rather elevated. So there's no really a dent in economic growth yet. So that actually saw the US stock indices kind of doing a consolidation mode on last Friday after the S&P and the Nasdaq 100 hit fresh all-time high on Thursday. So what you could see over here is that the SPX was almost unchanged, negative 0.01%. The Nasdaq 100 also almost unchanged, down negative 0.07% over here, and the worst performer were the Dow Jones Industrial Average and as well as the Russell 2000, both of them down negative 0.3%, and the small cap Russell 2000 down negative 0.6%. And in today's Asia session, we start to see a slight recovery as we are speaking right now on the S&P E-mini futures over here, which is up by 0.09%. What we could see, okay, let me share you my screen, so hopefully it will appear over here. Yeah, so this is the S&P E-mini futures. Okay, so at the start of the Asia session at this 6 a.m. mark over here, price of the S&P futures managed to actually stage a mini rally as we are speaking right now, and the Nasdaq 100 outperformed by 0.14% and intraday gain. This is the Nasdaq 100 E-mini futures. All right, so they are being traded on Globex. So that's why during the Asia session, we see prices is moving at this juncture. Okay, so now with that, also over the weekend, we do have this Japan upper house election over here. So in this Japan upper house election, give me a minute, where is it? Let me share my screen. Yes, so the current we call it the incumbent government, which is what I call it which is the party of the current Japanese Prime Minister Ishiba. His party kind of suffer a historic setback in the upper house election on Sunday over here. So his ruling coalition came in with a very lesser seat based on this outcome of the Japanese upper house election on Sunday. But however, he still continues to vote to stay on despite this historical election defeat by his party in the upper house. So what we could see over here is that in the FX market, the yen didn't actually weaken. Instead, the yen strengthened instead over here. All right, so let's take a look at it. So what we could see over here is that this is the 1-day rolling performance. Let me share you guys. Okay, so this is the 1-day rolling performance of the US dollar versus the Japanese yen over here. So at this moment in time, the yen didn't actually strengthen that much. Previously, at the start of today's Asia session is pardon me, what I'm talking about, the yen didn't actually weaken that much against the dollar over here. So what I could see over here, this is the 1-day rolling performance basis. The yen is actually at around almost unchanged at 0.1%. And based on today's intraday session, which is the start of the Asia session at 6 a.m. Singapore time, is actually down by negative 0.16%. So the reason why the yen is not moving, the dollar yen, why it's not weakening so much against the dollar, is because that market has really priced in this defeat by the current Japanese PM party, which is the LDP and its coalition. So it's more like a market is really expecting the current we call it coalition government, their voice may get weaker in the Japanese upper house, but so far the PM hasn't resigned and he continues to vote to stay on. So that also could potentially give a bit of stability to the Japanese yen. So that's why the dollar yen is not strengthening so significantly, despite the outcome of the election result that has been just released on early today's Asia session time. So what we could see over here is that the dollar yen now is actually down by negative 0.15%. All right, so that means the yen is not weakening significantly at all. So later I'll share with you some very interesting technical movement on the dollar yen chart, on the hourly chart, so that will actually form my view for today's intraday outlook on the dollar yen. So just hang on for a second, or for a few minutes, as I covered the first segment of today's daily dose. And also on last Friday, right, there's a US Federal Reserve official's public speech, which is Fed Waller. So Fed Waller, previously he was more of a we call it not really that very dovish officials, but in the last 2 to 3 months his stance has started to change. So previously he was more like a wait and see kind of a approach to decide when will be the next interest rate cut. So in the last 2 to 3 months he has been shifting to the dovish camp, and based on his public speech that was made on last Friday, he hints that of a July descent, and he may make a vote for a rate cut in July. But given the fact that there is not so much officials as dovish as him, so if you look at the CME Fed Watch 2, which is being calculated by CME, taken from the latest price action of the Fed Funds futures contract, that means taking into account of the implied traders expectation in the Fed Funds futures, and the CME Fed Watch 2 is able to do a probability calculation to measure the odds of a rate hike or the rate cut or stampede in the next upcoming FOMC meetings. So the latest one is in 30th of July. All right, so like I mentioned, even though Fed Wheeler right now he's turned into a much more ultra dovish guy over here, he hinted that he may descend in July and opt for a vote for a rate cut. But being the fact that in the last month or so, there is not so much of a dovish officials that is in the same camp as Fed Wheeler. So what we could see is that the CME Fed Watch 2 still assigning a high probability of a 95% chance that the Fed will not cut or may not cut on the 30th of July meeting, which is next week over here, to maintain it at 4.25% to 4.5%. All right, but if you go down the calendar after Fed Wheeler's a much more dovish comment that came on last Friday, the chances of that September cut, previously it was less than 60% last week, after that a couple of economic data releases. So now the chances has inched up higher to 61.2% or 61% that the Fed may ignite its first rate cut on the 7th of September meeting, right, to bring it down to 4% to 4.25%. So that's an increase of probability right now. And then thereafter, they will maintain stampede at 85%, right, on the 29th of October. And by the end of the year, before the end of the year, pardon me, on the 10th of December 2025 FOMC meeting, there's a high chance of 81% that the Fed would engineer another potential rate cut, the second one, to bring the Fed funds rate to 3.75% to 4% before 2025. And so that's still implying only potentially 2 interest rate cuts of 25 basis points each as being inferred by the decision of the Fed Funds futures traders based on the current price action as compiled by the Fed Watch 2. Pardon me. The only only significant change over here is that previously the odds of a September 17th of September 2025 meeting 25 basis point cut odds has increased from around 58% before last Friday. Then after last Friday, after Fed Wheeler's dovish speech, it increased to 61%. Right. So yes, that's the first segment I'd like to share with you guys. So now let us move on to the second segment for today. So before I touch on the second segment, let's have a quick overview of the FX market first. Right. So based on the 5-day rolling performance of the FX market, we know that last week we see a rather a pronounced push of the US dollar strength, and after on last Friday, this US dollar strength or rebound starts to dwindle off over here and starts to trade sideways. All right. So that also came in line with the downward drift of this US 2-year Treasury yield minus of the 2-year yield spread on the average versus that I actually do a calculation taking into account the major currency, which is the German, the UK, the Japan, Canada, Swiss, Aussie, and Canada. So it's a 2-year uh, of this average major economies. So the yield differential between the US Treasury yield and the 2-year average yield of this country, the yield spread has starts to reduce over here. That means US Treasury yield premium is getting lesser against the 2-year sovereign yields of these countries or this major economy, which is Germany, UK, Japan, Canada, Swiss, AU, and China, which I do a simple average of it. So that also kind of support the dollar's rebound that has been scissored out or fuzzled out since last Friday. All right. So now with that, let me now share with you the intraday technical outlook on the FX market first, starting with the euro dollar. So before that, let me expand my screen so that you guys can have a better view on the charts right over here. Okay, so euro dollar. So the euro dollar bounced as expected on Friday. So on Thursday, before I went for a short break, because Friday there's no daily dose. On Thursday, we do have a bullish bias on the euro dollar using the 115.80, 115.60. So hit our first resistance at 116.60. Then thereafter, it actually did a minor pullback on last Friday over here. So what we could see over here is that the hourly RSI still managed to be held above this parallel ascending trend line support level after that bullish divergence that has taken shape on Wednesday, right over here, where price action shaped a lower low, then the RSI shaped a higher low, then thereafter it continues to held above this parallel ascending trend line support that has formed after the bullish divergence condition. So with that, still no change. The key support level to watch for today will still be at the 115.80, 115.60 short-term pivotal support level. Still maintain our potential bullish bias. We call it outlook for a potential recovery, but price action got to break fast above 116.60 will still be our first intermediate resistance level to watch for today, and that level will be upside trigger level. Why upside trigger level? Because this level also coincide with the ongoing minor descending trend line that is in place since 3rd of July that is capping the bulls from gaining much more momentum over here. So in order for the bulls to gain a higher bullish momentum, it got to clearly break out above 116.60. So if our hourly close above 116.60, the odds of our bullish outlook for today will increase for the euro dollar to seek out the next intermediate resistance at 117.10, followed by 117.70 in the first step. However, if price action reverse downwards and have an hourly close below 115.60, today's bullish outlook intraday outlook or intraday bullish intraday bias will be invalidated to see the continuation of this ongoing minor corrective decline sequence extending further to the downside with the next near intermediate support zone to watch will be at 115.10 slash 114.90, which confluence with the rising 50-day moving average. Next up will be the sterling dollar. So sterling dollar on Thursday, we went to a neutral view due to mixed element. And over here, what we could see is that the RSI is not as rosy as the euro dollar RSI because the sterling dollar RSI, the hourly RSI, staged a bearish breakdown below the parallel ascending trend line support formerly that was in place since 16th of July. And it also inched downwards and below the 50 level mark. So indicating that bullish momentum is no longer in play on the euro dollar, at least in the short term. And after price got rejected on Friday, push up at the minor descending trend line resistance that is still intact since 1st of July high over here, and also reintegrate back below the former medium-term ascending channel support, now turns into a pullback resistance. So with that, I will flip back to a intraday bearish buyer stance for the sterling dollar using last Friday minor swing high area that also got similarly got resisted on 16th of July and 15th of July at the same level of 134.70. So using 134.70 short-term pivotal as much using 134.70 as my short-term pivotal resistance level, we will flip to a intraday trend bearish bias on the sterling dollar, with the first support coming in at 133.75, which is the minor swing low of 16th of July. A breakdown below it may expose 133.25 next. Only a bullish breakout and an hourly close above 134.70 that will invalidate today's intraday bullish bias, that will invalidate today's intraday bearish bias, pardon me, and potentially kickstart a recovery process on the sterling dollar to seek out the next intermediate resistance level at 135.45, followed by 135.80, which confluence with the 20-day moving average, acting as a similar resistance level as well. Okay, so that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar, after almost hitting our bearish outlook support level at the previously, we have this 0.6445 over here. So that is the printed an intraday low of 0.6454 before staging that minor V-shaped recovery on Thursday and managed to reintegrate back above the 50-day moving average, indicating there is some signs of bullish momentum coming into play as well. And also last Friday, further uptick in the hourly RSI also managed to clear above a former parallel descending trend line over here. And in today's Asia session, it looked to stage a bounce close to the retest of this former uh, descending trend line resistance of the hourly RSI, now turns into a pullback support level at around the 46 level mark over here. So with that, using a pivotal support at 65.85. So this 65.85 is also very close to the 50-day moving average, pardon me. And if you do the Fibo retracement of that minor V-shaped recovery from the low of 17th of July all the way up to last Friday intraday high at around the 65.40 level, that also confluence with the Fibo with the what I call that the 61.8 Fibo retracement level, the golden ratio as well. So with that, using 64.85 as my short-term pivotal support level, given that Elements has now turned to be less bearish on the Aussie dollar from an intraday perspective, first resistance level to watch will be at 65.40, which is the minor high of Friday. Above 65.40 may seek out 65.75 next on the intraday basis, which is the minor swing high of 14th of July and 15th of July. Only a bearish breakdown below 64.85 and the hourly close above it, below it, price action will revert back to the bearish bias to actually float down towards the lower limit of that sideways range configuration, exposing the next near-term support at 64.45 in the first step. A breakdown below 64.45 may see 64.20 next. So that's for the Aussie dollar. Lastly, we in the FX market will be the dollar yen. So the dollar yen now today it is an attempt to actually break down and now retest this former minor ascending channel support, now turns into the pullback resistance level taken from the low of 1st of July over here. So with this kind of bearish breakdown in today's early Asia session and the retest of it right now on this former minor ascending channel, now turns into a pullback resistance, I will flip to a intraday bearish bias First resistance level to watch will be 149. Just in case of any whipsaw, I put it slightly higher. The pivotal resistance will be at 149.60, which is so confluence with the 200-day moving average. So as long as price action didn't pierce above 149.60, pivotal resistance to watch out for today, I will flip to a intraday bearish bias stance on the dollar yen. First support level will be 146.70, which is the minor swing 147.70, pardon me, not 146. First support level to watch will be 147.70, which is the minor swing low area of 17th of July. A breakdown below it may expose 146.80/145 145.55 level. All right, only a bullish breakout above 149.60 and an hourly close above it that continues the impulsive up move sequence towards 150.40 followed by 151.15. So this 151.15 is actually the minor swing high area of 28th of March this year. Right, so that's for the dollar yen. Flipping to a intraday bearish bias using 149.60 as my pivotal resistance level. Okay, so that sum up the intraday technical outlook on these four major US dollar pair. Let us now shift our focus to the major stock indices, starting with the Hong Kong 33, which representing the Hang Seng Index over here. So the Hong Kong 33 managed to pierce up above that former medium-term swing high from 18th of March to 19th of March previously over here. So this is considered as a medium-term swing high. Why? Because before that price action do a very strong significant up move during the 14th of February period, exposed Chinese New Year. Then thereafter hitting 18th and 19th of March, it starts to be in a sideways configuration and do a bit of a minor pullback here and there that lasted for around 3 months plus or 2.5 months plus over here. So bullish breakout above this level of 18 of formerly 18 and 19 of March medium-term swing high signified the ongoing medium-term uptrend phase of the Hong Kong 33 still remains intact. So right now it managed to, after doing that bullish breakout on last Friday, now as we are speaking in the Asia session, is doing a bit of minor consolidation, holding above this former medium-term swing high of 24,850 now turns into the intermediate pullback support. So I will use a slightly lower level as my short-term pivotal support for today, just in case of any whipsaw, using 24,650, which is so the intraday minor swing low of last Friday at the start of the Asia session. So this is a tighten pivotal support, by the way, because previously the pivotal support was at around 24,050. So I tightened up the pivotal support for today because it has breached above the 24,850 level on last Friday. So as long as this tighten pivotal support of 24,650 holds today, we will still have maintained our bullish bias on the Hong Kong 33. The Hong Kong 33, pardon me, with first resistance level to watch, or the next resistance level to watch at 25,065 / 25,150, then thereafter followed by 25,400, 25,480, which is defined by a Fibo clustering levels, and as well as the upper limit of this ongoing minor ascending channel that is still in place since 22nd of June 2025 low over here. Okay, give a minute. So I think this one I didn't draw it, just suddenly. Okay, it should be drawing like this. Okay, just now accidentally I do the slight adjustment. Okay, so that show the 25,400, 25,480 confluence with the upper limit of this minor ascending channel that is still in place in 2nd of June. So only a sudden bearish breakdown below 24,650 that would negate today's intraday bullish bias to see a minor corrective setback taking place again, exposing the next near-term support at 23,390 / 24,050, which confluence with the rising 20-day moving average as well. Okay, now next up will be the Japan 225. So the Japan 225 on last Friday managed in fact in today's on last Friday it managed to stage that bullish breakout above this minor bullish ascending wedge resistance, now turns into a pullback support, managed to survive that support on Friday, and in today's Asia session, it attempt to actually test and stage a bullish up move after the retest of this former bullish ascending wedge resistance now turns into a pullback resistance, and also did a minor reversal after the test on the 20-day moving average on last Friday as well. So today liquidity will much lower on the Japanese market because the cash Japanese stock market is closed for today for public holiday. So first support level to watch for the Japan 225 CFD index, which is our platform, which is mentioned in our platform, and also that's representing the Nikkei 225, will be at the pullback support line over here of their former ascending wedge resistance at 39,720. Pivotal support level, I will tighten it slightly higher to last Thursday minus swing low area at 39,400 level. So as long as 39,400 level holds on the Japan 225, we'll maintain a intraday bullish bias. Next support level to watch, next resistance level to watch will be 40,110, which was last Friday minor swing high, that confluence with the minor swing high previously of 4th of July. Above it may seek out the next intermediate resistance at 40,355 in the first step, which is the minor congestion area of 30th of June and 31st of June. And 1st of July, pardon me. However, if price action starts to do a breakdown below 49,400 and the hourly close below it, then this recovery scenario will be invalidated for the Japan 225 to see another round of choppy corrective downward drift to retest the next intermediate support at 39,145. Below it exposes the all-important former medium-term range resistance that was previously from May 2025 high, now turns into a critical medium-term pullback support at 38,850. There's also going to be confluence very closely to this ongoing rising 50-day moving average. So that's for the Japan 225. Next up will be the Germany 30, representing the German DAX. So the German 30 managed to do that squeeze up as intended on last Thursday, almost hit our resistance level at 24,520 before staging that pullback on last Friday over here. So first support level to watch will be at 24,200, which is the lower boundary of this ongoing minor ascending channel that I draw from the low of 20th of June. Pivotal support level to watch will be a slightly adjusted one at 24,040, which is the rising 20-day moving average and the minor congestion area of 16th of July. So as long as 24,040 holds, still maintain our intraday bullish bias for today. Next resistance level, first resistance level to watch will be 24,520, followed by 24,760 next, which is a Fibo extension cluster levels. Only a bearish breakdown below 24,040 will invalidate today's intraday bullish bias for the Germany 30 to kickstart another round of minor corrective decline sequence, exposing the next 50-day moving average, which is confluencing at the next intermediate support level at 23,930. Over here, a breakdown below 23,930 sees a steeper minor corrective decline sequence unfolding, retesting the minor swing low of 2nd of July, acting as the next intermediate support at 23,640. That's for the Germany 30. Now, let us now focus our attention to the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 on Thursday, it managed to clear above our pivotal resistance level that invalidated our bearish view on the US Wall Street 30. So after that sell-off and a retest on Wednesday at this 20-day moving average, it seems to us that the US Wall Street 30 has already kickstarted a new bullish impulsive uplift sequence over here. That means, i.e., the corrective sequence from 17th of July to from 7th of July all the way down to the 16th of July, around 2 weeks, has more or less ended, and the US Wall Street 30 is maybe in the process of a fresh impulsive up move sequence. So with that, we will flip to a bullish bias for now, got to respect the recent bullish price action of the US Wall Street 30, using 44,150 as my short-term pivotal support level, which is the minor swing low area of 17th of July, and so confluence with the rising 20-day moving average. Flip to a intraday bullish bias. Intermediate resistance level to watch will be at 44,620, which is the ongoing minor descending trend line that is still in place since the minor swing high of 7th of July. A breakout above 44,620 will give the bulls more prudence to seek out the next resistance level at 44,850, followed by the current all-time high 45,100 that is printed in December last year. Only a bearish breakdown below 44,150 and an hourly close below it that would invalidate today's intraday bullish bias to see another round of choppy corrective decline sequence unfolding again, retesting 43,800 / 43,600 in the first step. So that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also cleared above our pivotal resistance level at 6,290 on last Thursday, and on Friday it did a pullback, and after that pullback take shape, it managed to survive at this level as well. So what we could see over here is that the minor corrective decline from 15th of July all the way down to last Wednesday, 16th of July, may have already ended as well. And right now we are in the midst of a fresh bullish impulsive upmove sequence for the SPX 500. So with that, I'll be using a pivotal support level at 6,255. Above it, first support level to watch will be at 6,290. So as long as the price action didn't dip down below 6,255, which is the pivotal support for today, we will flip to a intraday bullish bias stance for the S&P 500. Next resistance level to watch will be 6,330 / 6,355. Above it, seeks out a next resistance level to come in at 6,370, 6,380, which is being defined by Fibonacci extension clustering levels. Only a bearish breakdown and the hourly close below 6,255. Today's intraday bullish bias view will be invalidated to revert the situation back to the best for the minor corrective decline sequence to unfold again, exposing in first step 6,220, which is the minor swing high area of 16th of July, 9th of July, and 8th of July. Below it exposes the next intermediate support level at 6,180, and also realize that 6,220 also confluence with the rising 20-day moving average. Lastly will be the Nasdaq 100. So the Nasdaq 100 also managed to clear above our pivotal resistance zone at 23,020, 22,920. So invalidating our bearish bias stance for the extension of the minor corrective decline. So the minor corrective decline may have ended. Previously, it was in place from 15th of July all the way down to the low of 17th of July. So from 17th of July, with this bullish hammer reversal candlestick right at the pullback support of that former bearish ascending wedge configuration, now turns to a pullback support at 22,650. We also confluence with the rising 20-day moving average. This positive movement more or less has ended the minor corrective decline phase, previously in play from 15th of June till previously in place since 3rd of June till 16th of July. All right, so this is like a sideways consolidation, sideways corrective consolidation move. So right now we may be in the pace of, or in the pace of a fresh impulsive up move sequence to potentially seek out a new fresh all-time high on the Nasdaq 100. So with that, using 22,920 as my short-term pivotal support level for today, we will flip to a intraday bullish bias on the Nasdaq 100 above 23,190. Seek out the next intermediate resistance at 23,400 / 23,480, which is defined by Fibonacci extension cluster levels. Only a bearish breakdown in the hourly close below 22,920 that would invalidate today's intraday bullish bias view and kickstart another round of minor corrective decline sequence, revisiting 22,650 again, that confluence with the rising 20-day moving average. Only a breakdown below 22,650 may trigger off a deeper corrective decline sequence unfolding, exposing the next near-term support level at 22,390 in the first step. All right, so that sums up the intraday technical outlook on the six major stock indices, pardon me. So with that, now let us now focus our attention to the commodities market, starting with Gold XAU / USD. So Gold XAU / USD continues to help at the medium-term ascending trend line that is in place since 31st of December 2024 low. Retested it 3 times so far since the test of 30th of June, that every time it tests, price action push up higher. but so far it can't break above this short-term stubborn resistance range of 3,360, 3,374, which is the minor swing high area of last Thursday, 17th of July. So with that, no change. I'll be still watching this short-term pivotal support at 3,328 level so far. Okay, 3,328 level. Okay, and as well as holding above this 50-day moving average as well. So using 3,328 as my short-term pivotal support level, still maintain our intraday bullish bias on Gold XAU/USD. But first resistance level remains unchanged, which is also our upside trigger level at 33,060, 33,074. So okay, 3,360, 3,374. So a breakout above 3,374 with hourly close above it, then I would say that we have a proper bullish breakout after this very tight minor congestion range that has formed since 3rd of July. So a bullish breakout with an hourly close above 3,374 that will give the bulls more prudence to potentially see the start of a fresh impulsive up move sequence. So in first step, retesting 3,400, then followed by 3,450 next. However, a price action breakdown below 3,328, then we will have another round of choppy movement today again, retesting the minor swing low of 3,309, which was previously on last Thursday. Breakdown below 3,309 may expose the next intermediate support zone at 3293, 3282, which is the minor swing low area of 9th of July. Okay, so that's goal for you. Still maintaining that intraday bullish bias using 33,280 as my short-term pivotal support. Upside trigger level will be at 3,360/3,374. Okay, next up, and lastly will be the West Texas crude oil. So West Texas crude oil on last Thursday, before we go for a short break on Friday, we play up the push up within this sideways range configuration that is still in place since 25th of June. So hit our resistance level and also the 200-day moving average, and price action thereafter do a intraday sell off on Friday. So given that the hourly RSI also has started to oops, where is it? Okay, I accidentally deleted off the RSI. Okay, so the RSI also has shaped a bullish divergence as well before inching down lower on Friday. So given the fact that price action moved higher, RSI bearish divergence, indicating that last Friday push up has a lack of upside momentum. So given this lack of upside momentum, there is a lower odds or lower chance right now that it may break above the range resistance at 69.15. So with that, using 69.15 for today as my bearish to reinstate my bearish bias view again within this sideways range configuration. First support level to watch will be at the range support level at 66.10. A breakdown below 66.10 exposes 65.20 and 62.75 next, which is the minor swing low area of 2nd of June and 4th of June. Only a bullish breakout and an hourly close above 69.15 that would invalidate today's intraday bearish bias view to see a bullish breakout from this sideways range of close about what, 3 to 4 weeks, 4 weeks already from the low of 25th of June, exposing the next resistance level at 70.60 followed by 73.60 next. All right, so that's for West Texas oil. So that's also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today's session over here? So at the start of today's session, we have the China interest rate decision on the 1-year loan prime rate and the 5-year loan prime rate. So this 1-year and 5-year loan prime rate more or less tied to consumer loans, that is inclusive of the housing loan as well. So the PBOC, which is the Central Bank of China, decided to maintain these rates unchanged. The 1-year rate unchanged at 3% and the 5-year loan prime rate unchanged at 3.5% over here. And going forward into the European session will be rather quiet. And one key data to look out for in the US session will be Conference Board Leading Economic Index over here. So this leading index comprises of various leading soft economic indicator from the US. and conference board compile it on an aggregate basis and name it as a leading index. So this index also can be very important because any chance of a recovery, previously it was sloping downwards, that indicate a better economic prospect for the US economy and also reduces stagflation risk. So for the month of June, market is also expecting a month-on-month decline of negative 0.1%. That is in line with the negative 0.1% printed in the previous month of May. So this conference board leading index will be out at 10 p.m. Singapore time. And before the start of tomorrow's daily dose, which is on the 22nd of July, at 9:30 a.m. Singapore time, we will have RBA meeting minutes. So this meeting minutes will be scrutinized because RBA surprised market participants in the previous week when they decide to actually hold interest rates instead of cutting. So market participants will be looking at the minutes to actually decipher the thinking of the Federal Reserve officials at that point in time. So that could influence the Aussie dollar, the Aussie crosses, and as well as the ASX 200. So that's 9:30 a.m. Singapore time. All right, guys. So I sum up today's daily dose of market insights. Kelvin here signing off. And I wish to make a quick announcement. Tomorrow there'll be no daily dose as I'll be away in the morning. So daily dose will resume again on Wednesday, the 23rd of July. So I wish you all guys a great day ahead, and we shall speak on Wednesday, 23rd of July. Thank you.